Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with our program and our podcast, we do this podcast weekly. What we want to do is bring you the real information, what's taking place in the economy, and mostly in regards to real estate. But we're going to give you, more than nitty-gritty details of what's taking place in Congress with the Federal Reserve, that's affecting mortgage interest rates, that's affecting home prices, and ultimately could affect you and your real estate decisions. We have this. Obviously, you can check out this podcast on iTunes. If you want to download it directly to your iPod or your phone, you can do that. If you go to iTunes directly, you can actually type in the search Real Estate 360. And it'll allow you to download the podcast there. You can also stream the podcast on our website at realestate360live.com. That's realestate360live.com. Also, on that website, there's an Ask Question button on the right-hand side that I ask listeners if you have any questions for us that you'd like for us, or topics that you'd like for us to bring up. We'd be glad to do that. I mean, part of this podcast is to be very informative and to answer questions that people have. Many people obviously are paying attention to the national radio and TV, whatever it may be, that kind of persuades you to make a decision one way or the other. And what we kind of do is break down what the media is putting out there and kind of tell you why those things are taking place and why you might want to think differently about what's being put out there in the news. Joining me on our panel, as he does every week, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the industry as a real estate industry expert, been cited in the Wall Street Journal, Forbes, Fox Business, Smart Money, MSN, and numerous others. Louis, how are you doing today?
Doing grand, Ryan. How are you?
I'm doing well, sir. Thanks for asking. So,
excellent.
We had our podcast about a little over a week ago now, and, heading into the day after, I believe, is when we spoke about what the GDP numbers were going to come out to be, and they ended up coming out to be just slightly higher than expectations. Which was kind of par for the course of the way we were headed, because we had a couple of negative economic reports right before then, and as we touched on, it's always like as things start to get negative, all of a sudden we've got to turn around and have a couple positive reports, which is what we've had. So what I wanted to do today is kind of dive into our potential predictions for 2014. We typically do that once a year, and I figured we'd go ahead and give it another shot this year to see how close we can actually nail some of these things. From interest rates to the economy to the Federal Reserve, gold, silver, will there be a QE3? We'll dive into all these things, but I just kind of wanted to give your take as we went through and got those reports at the end of last week. I mean, is this pretty much what you anticipated? We're going to get a little bit more positive economic news moving toward the end of this year and into the new year, basically keeping that consumer confidence high, and then obviously come the beginning of the next year, once Yellen takes her post as the Federal Reserve chairman or chairwoman, that things are going to have to at some point change or be altered. Or is there going to be more quantitative easing? Is there going to be less? Is there going to be more of a taper? What are your overall thoughts moving through into 2014?
Okay, well, it looks like when you have that positive GDP number that the Fed can pat itself on the back and say, you see, we tapered at the right time, economy's on the right track, GDP is on the way up. But if you look behind the GDP number, that's all inventory buildup, and, that could all reverse course, which is perfect for the Fed in the first quarter, because if in the first quarter the GDP declines, as those inventories are worn off and not replaced, then the Fed can say, oh, it was unanticipated, and we're going to have to do more, and it wouldn't be prudent at this time to continue with the tapering program that we started last year. But we really meant it when we did it. We're not going to do QE forever. We're not intent on printing money forever. The economy is going to be strong enough. This is just a blip in the road. And again, it's just another way of kicking the can down the road and using monetary policy to cover up for basic structural defects in the economy. And if you go back, Ryan, now, if you look at last year, the macro view would be scarcity. There's a decline in home sales. There was a decline, reduced new homes built, no jobs, lower wages, fewer doctors, less production. But yet, we had an increase in home prices. We had an increase in benefits paid, unemployment, disability, food stamps, healthcare premiums. So the answer to a lot of our issues of scarcity are higher prices, which in some instances they cheer on. So, for example, well, home sales are down, but prices are up, so we should be happy about that. Most prices, when they rise, are not a good thing, but yet we've been conditioned to believe that rising home prices are somehow the best thing since sliced bread, since they improve the economy. Similarly, the same thing with the stock market. The stock market went up, prices are up, so therefore the economy must be better. And what we're seeing, Ryan, over the last 5 years, I think, is that we have no real markets. All the markets are manipulated. It's all intervention. And that's not a conspiracy theory, because if you think about it, the Fed is on record as the number one market manipulator. They're saying they are there to help increase home prices, to help boost the stock market through their monetary policy. Well, don't think it just stops there. All their good work in manipulating interest rates lower and home prices higher and the stock market higher, well, of course they're going to be involved, or some part of the either the US Treasuries, through the exchange rate stability fund, or through the Fed itself, are going to be involved making sure that all markets are kind of playing nice with their overall plan to pump liquidity into the banks. So what my whole thing about 2013, 12, 11, and 10 is that they have tried to paper over all the scarcity in the economy by putting in more free money. And if you use a simple analogy like Robinson Crusoe, when he's on an island, he needs goods and services. He doesn't need money. But the Fed's view is, well, we have scarcity, we'll just create more money. Well, giving Robinson Crusoe more money, if $1 isn't going to help him, 10 isn't going to help him, 20 isn't going to help him. And I think this highlights the fact that more money isn't helping the overall economy. It's helping the two main clients of the Federal Reserve, which are the banks and the U.S. government. The U.S. government needs lower interest rates, so the Fed prints money. The banks need more money so they can remain solvent and so that they can invest and make more money. So they print more money. But unfortunately, what we've had in the last 5 years is declining home sales, declining jobs, declining wages, and so on. And only we've had increased home prices and increased stock market prices. So I think 2014 will be the year where we pull back the curtain and realize there's a limit to how much you can paper over these issues with more money, because it's becoming increasingly clear that this money is all going to the wealthiest. It's not trickling down to the rest of the economy. So I think in 2014, at some point, you'll see a break in the stock market. You'll see a massive decline in home sales as investors will flee that area. And then you'll start to see a new kind of tactic that doesn't involve QE, but kind of involves preparing the citizens for sacrifice. And I think we've kind of tried to avoid that concept, but I think in 2014 we'll start seeing signs of trying to prepare people for sacrifices in terms of perhaps rating your pension plans, perhaps raising taxes, lowering expectations as to what can be done, and maybe even cutting benefits, bail-ins, things of that nature where the citizens are actually called upon to kind of pay for all these excesses.
Right.
And what are your thoughts?
I mean, I agree with you pretty much 100% of what you said. I think that, it's pretty interesting because most of what you mentioned there is that we have an artificial market. We have an artificially propped up stock market. We have an artificially propped up real estate market, which gives people a sense when these prices are rising that everything's okay, the appearance, right? But that's actually not good for us because this is all artificial. We didn't have a housing recovery built on rising wages and strong employment, right? Which would be something that you and I would pay attention to and say, you know what, okay, this makes sense. We're having gradual moves and appreciation in home prices because we've got the the strong economy and the employment to support that.
And increased home sales. We don't have increased home sales. We have decreased home sales.
We have decreased home sales, and a lot of the home sales that are actually taking place or were actually taking place are a lot of investors, right, that were buying hedge funds and just people that have cash money that were looking to buy the real estate as an investment, not as, somebody going out there to buy their primary residence. And the fact of the matter is, with the low mortgage interest rate environment that's been created by the Fed. So, for all of our listeners out there that hear us talk about the Federal Reserve and them tapering or not tapering, this has created, extremely low interest rates for consumers that most people are unable to still take advantage of to this day. And everybody, I have people out there that will still tell me, Ryan, whatever, you're talking about this, real estate, it's up, it's down, it's cyclical, that's always what happens. Yeah, but we haven't seen the likes of what's been transpiring over the last 5 years where, you actually have the Federal Reserve physically going and buying up pretty much all of the mortgage-backed securities that are put out there. That's not a normal market. That's not sustainable. And then, by them doing that, as you mentioned, Louis, they're not intending for this program to help the average Joe that's out there. This program is intended to prop up the bank's balance sheets to help them. It was to basically get them healthy, but now it's not only got them healthy, it's got them in a position where they've got so much excess capital, they can then reinvest in the stock market, prop it back up even further, and reap the rewards there. It's not helping the average everyday Joe, and it's a frustrating thing to me because I'm more of a protector. I try to help people make the right decisions based upon the information that we have. And as you and I talk, week in and week out, we find ourselves talking about the Federal Reserve because this is the main driving force to what's taking place in our economy right now, which is not much of anything. Now, the economic reports that come out, like you said, when you dive into them and you strip out certain numbers, you can look at them and say, well, these numbers are still terrible. But what does CNBC and MSNBC and all those business channels, they find the good in that, and they'll really push that out there. And once again, their motives are what? To keep driving these things higher. Now, moving forward to 2014, as you said, I think it's going to be quite interesting because now we have mortgage interest rates which will be rising up. So let's just say the average interest rate is heading into the 4.5% range. I'm trying to pull up a 30-year fixed. The average 30-year fixed right now this week is 4.56%. Last week it was 4.48%. That's on a 30-year fix. We have the 15-year fixed at 3.57. We have 5-year ARM at 3.74. So where do I see mortgage interest rates going from this point forward? I think that they're going to move higher. They're going to move into that 5% range, which ultimately, what does that do, Louis? When interest rates move higher, banks are willing to take a little bit more risk, right? Because they're willing to pay, get a little bit of a higher return. They'll take more risk. And we've already seen that mortgage applications are way down. So
rising rates, that's not going to make the increase, and they're going to play the whole nonsense of the spin that, well, these are still historically low rates. Yeah, but we're in historically low employment rates, historically low wage growth too. So that's what they're going to be telling people is that these rates are still low. That's what the Fed is going to say, that they're historically low, not realizing that we're in a historical anomaly in very bad times.
Absolutely. And you know what they're going to do, and I've been reading from many lenders and banks, they're already preparing to loosen their underwriting guidelines because you can't have rising interest rates and an employment situation that's not getting better, it's getting worse, and think that people are just going to be able to apply for these mortgages with rising home prices to keep up this charade. It can't happen. So they're already, basically, like I said, the Citibank.
They're ready to fleece if you think about it. Because,
Absolutely.
Higher rates and reducing the requirements so people will pay more for these houses that they couldn't afford last year. Now they're going to pay higher prices, higher interest rates, and be locked in. You're creating another circumstance where you're going to have more people that are underwater in their homes. Fortunately, though, Ryan, I don't think they'll get the volume out of it this time.
No, I don't.
In other words, in 2003, 4, 5, everyone was buying a house. I think now, even with they reduce the guidelines, there's not going to be this big rush into housing the way there was back then. Because I don't think the home prices can be sustained much higher.
Yeah, well, and the interesting thing is, too, even if they do loosen guidelines, like let's say instead of a 620 credit score requirement, they go back down to like 580, right? So they loosen the credit score requirements. That's still, most banks and underwriters are not going to allow for job gaps in employment, and things that are really the major issues in our economy right now, right?
Which more people have now than they had in 2003, 4, and 5.
Absolutely. So there's more of that going on. So, yeah, I feel like even if you do loosen the guidelines, we're still going to have a very soft 2014.
Well, what if they start including, and I wouldn't put it past them, that if you've been on benefits for a certain period of time and you've shown consistently that you can continue to receive those benefits, that therefore you should be able to get a mortgage? You
should be able to count that as income?
Yes.
Yeah, I mean, you know what? Anything is possible. You can't put it past.
Well, because people now, you're getting to the point when the labor participation rate drops below 60%, that, you're having people who are not working but somehow are living and receiving benefits and receiving some form of income through the government. Well, they have a good argument to say that they should be able to use that income towards the purchase of a house. Why shouldn't they be allowed to buy a house when people with jobs can buy a house? I think that's the mentality that we're headed towards.
Yeah. Yeah, it's going to be very telling for me. There's still a lot of people that are out there that are saying, hey, we still have a shortage of inventory. We still have a shortage of inventory. Okay.
You do. But that's, go ahead.
No, and most of the reason why we have a shortage is, well, we still have pretty much almost, 25% of the national
are underwater.
Properties are underwater, right? So we got 1 in 4 there that's underwater. So, yeah, if they can't afford to get out of it without having to come bring money to the table, then they're not going to be selling their house.
Right, and then home builders are building homes at a rate 3 times less than they built them 7, 8, 10 years ago, because they know they're really, even though there's a shortage of inventory, the demand isn't that robust. That if they were to build more homes and increase the inventory, which they're doing slightly from their lows of last year and 2 years ago, that there really isn't that much demand because the job market isn't there and the ability to purchase those homes isn't there. So this low inventory, is back to what I was talking about earlier in the program, is based on this mentality of trying to squeeze higher prices out by artificially creating scarcity.
Right.
Having this low demand, this low inventory, and then trying to boost demand up against that low inventory. That's not a healthy economy. And unfortunately, they're using the housing market to try to push the economy forward, whereas you and I have talked about for years that the housing market should be reflective of the strength of the economy, not the driver of it, which they're trying to make it. And it's falling flat on its face because we don't have that many home sales. And the home sales that we have, 40, 50% are by investors. So it's not a healthy economy, and it's not driving the economy. It's just driving some profits for some people who are able to flip homes or to buy them and rent them.
Right. So my next question to you then is, for as far as 2014, we know that Janet Yellen is supposed to take her post next year to relieve Ben Bernanke, and she supposedly has even more of accommodative policies than Ben did.
And is more interested in the labor aspect of the economy, supposedly, than Ben was.
So knowing that, what do you think their stance is going to be? Are they, if they start watching interest rates rise and then they continue to watch existing home sales not really move, new home builds not really going anywhere, the labor market not really going anywhere, what's their next plan of attack? What do you think their next move is?
What they have to do, Ryan, is they have to get away from QE. They need to regain credibility. So they're going to have some event happen that allow them to do something differently, that doesn't just involve printing money and buying treasuries and buying mortgage-backed securities. They're going to have to get involved in a much more creative way. I don't know what it is, but they're not just going to continue doing QE, because at some point people will realize, the markets will realize that it doesn't work. Rates will go higher anyway, no matter how much QE they do. They're going to need to have some type of controlled demolition of something, a portion of the economy, whereby they can intervene in a much more creative way, whether it's infrastructure bonds, whether it's I don't know what it is. They have all means of tools, as they call them, if they wish to stimulate the economy. Right. QE hasn't done it. I think everybody knows that. And if they don't continue, if they bluff, if they try to stop tapering and blame that, well, the economy is not healthy. Well, sure, it's not healthy. It hasn't been healthy for 5 years. Doing more QE isn't going to help it. So they're going to have to come up with some other way of intervening in the economy and helping the employment situation and so on. Those are the fronts that they use to excuse what they're doing. They're really not interested in improving the economy or helping unemployment. But if they see these things getting out of hand, they're going to have to try something different. I don't know what it is, but I don't think they can do QE for another 2. People are saying QE infinity. They can't stop, because if they do stop, then the U.S. government borrowing costs rise, the economy collapses. They know that, but they also know continuing QE will also cause a collapse. Right. You cannot continue printing money and saying it's working when it's not for 5, 6, 7, 8 years. So they'll come up with, I think 2004, I don't know what it is. They'll come up with something different in order to intervene. There will never be a case where they'll just step back and allow the free market to do its magic. They will come up with some other type of intervention, and my prediction is it'll be far worse than QE, far more intervening. Could be, as I mentioned earlier, it could be bail-ins. It could be, we talked about one of their exit strategies could be, if you take people's pensions funds, a certain portion of that, that's better than printing money. You actually take real money and move it into US Treasuries out of people's pensions funds. I'm not predicting any of these things will happen, but something like that, something outside of QE that's far more intrusive and far more impactful on the average citizen, where they're actually being called upon to make some sacrifice. See, right now, through QE, we're not really sacrificing. We're supposedly receiving these benefits passively, even though it's inflationary. They're preventing deflation. They're keeping us from lower prices by printing money. But I think they're going to move more towards contributions, bail-ins, that type of thing, to keep money in the system.
Yeah, I mean, and you brought up a good point, because my whole line of thinking was, and obviously at any point Congress can give them more authority to do more, right?
Right.
They've done it before. They'll do it again. I mean, in desperate times, there's desperate measures taken, and we're almost at that point again, right? So it's like
they can't carry on, Ryan. You're right. You cannot. They can't keep doing QE and say with a straight face it's working and we got to continue it. If it hasn't been working for the last few years, doing more of it logically isn't going to help.
And it's amazing to me that Bernanke or anybody can sit there and say that they've accomplished their objectives with QE, which was what? To make the banks rich again? That was the objective, was to get them, to take them from being unhealthy to make them not even healthy now, but we're so far beyond healthy that now...
And to allow the U.S. government to increase its deficit?
Increase their deficit. Now banks are right back taking risky bets again, just like they were before, right? I mean, it's no different than what we just out of. And unfortunately, who's the one that pays? The middle class. They're getting pushed further and further down. And they brought up numerous programs. Now, could it be that they create something for infrastructure? Well, that would make a lot more sense than what they're doing now, because at least that would create jobs long term, which would increase the employment situation. People would have money then to potentially go out there and buy houses and do things like that, right?
But that's artificial too.
Yeah, but I mean, it would have been.
they're going to have people dig ditches across the country and then fill them back up again.
Well, that's true. It would have been better served than buying mortgage-backed securities.
Oh, anything would have been better.
That was going to do something. You know what I mean?
Ron Paul said you just give the people money. Not that he advocates that or I advocate that, but if you're going to spend $5 trillion buying mortgage-backed securities off of the banks, that makes no sense at all, other than you want to help the banks.
Right, or
and their friends, so they have lower interest rates so they can buy houses.
Right, or the other program, like Britain had instituted, the Lending for Funding program, where basically they would give money to the banks, but on condition that they had to lend that money out to small businesses or whatever.
Right. Also, they had the program where they had to lend the money to people to buy houses, and the government would give you money to buy a house. That just creates a housing bubble.
Exactly. It's exactly what it creates. I mean, we and the thing about it is that, see, I've read many analysts are projecting for anywhere from a 3 to 5% increase in home prices for 2014. So I think that while that could happen in certain geographic areas throughout the country, I think that in many areas it's going to be a standstill, if not moving backwards. Because we talked about this, Louis. Like, let's just say that, you know, last year there was people underwater that were just barely underwater, but now they're not underwater anymore. They're going to all be looking this spring to potentially put their house on the market all at the same time, right? So
at the same time that interest rates are higher, which lowers your demand. Which
will then give us the data that we need to say, okay, look what happened. We now have rising interest rates. Now we have a lot more inventory coming to the market, and guess what, guys? It's not moving any longer. So what do people have to do to sell their house? They have to reduce their price down to be competitive, right?
Yeah, well, when they reduce their price, though, then or they take their home back off the market. Because if they reduce their price to the point where now they're no longer above water, then they're not going to sell.
Yeah, I agree, and I feel like that certain metropolitan areas will have slight appreciation next year, but I feel like on the whole that it's going to be somewhat just stagnant. Not much.
Something has to Something has to break, because you cannot carry on in this manner we thought you couldn't carry on past 2012.
Right.
But I think we've seen a doubling on the 10-year note in just 6 months.
Right. It's at 2.99% right now, and it was at about 1.5% before.
Exactly. And you can't continue this, and everyone paying attention to what the Fed does, if it's only whether they're going to taper or not taper, it's going to get old pretty quickly. And you're seeing, it's not just what the Fed does anymore. People are not paying attention to what the rest of the world is doing. If you look at all the gold moving over to China, if you look at what China is doing, you look at what Japan is doing in terms of trying to outprint and outrun inflation. The Fed is trying to do the same. These guys can't even create inflation with all the money they're printing. And meanwhile, China is just buying up all the hard assets, not just gold and silver, but fine art, vineyards, real estate, and so on. The United States cannot continue just to try to print its way out of and raise prices on the few assets. If you think about housing is already an existing asset. It's not a productive asset. It's not like in the last 5 years, home prices went up because something happened. They just changed the price of them. There hasn't been additional production in the economy. The house is still the same old house.
Right.
So the United States is actually trying to squeeze the last water out of the stone rather than trying to reduce this scarcity complex and trying to raise prices on scarce items, but rather instead of trying to produce new items. And the United States, if you think about what have we come up with in the last 5 years? Facebook and Twitter.
Right.
People can talk to each other or advertise, but there's not an increasing pool of products and services in the last 5 years to justify rising home prices and rising stock market. And that has to give at some point, because you can't keep pushing the economy higher through scarcity. It has to be increased through increase in productive capacity, not just consumption. And there's even a limit to how much people can consume if they have to borrow to consume it.
Right.
So I think by mid-2014, something will appear that'll show that the economy is broken, and something dramatic is going to have to happen. It's not going to fix it, and unfortunately, they're not just going to allow the pieces to reassemble the way they would naturally. There's going to be a massive intervention.
Yeah, and I mean, I feel like we've been saying, this for quite some years now, that at some point, something has to happen. Something has to change. I mean, maybe the first step towards that was them, at least making that first taper, because they can't really undo that they've done that now. But what they can do is either increase or continue to decrease. But I think they already know what.
Well, Ryan, hold on. We know what the reason they tapered was. You and I didn't consider this. The impact of that taper is no taper at all, because for 3 or 4 years they were adding those treasuries and mortgage-backed securities to their balance sheet short term. Well, they've become due in the last year or so. So just reinvesting those portions adds another $10 billion on top of it a month that they have to reinvest. So they basically stayed at $85 billion, even though they tapered.
Yep. So they gave the appearance that there was a taper, but really, at the end of the day, it's pretty much a wash.
Correct.
Yeah, and you know, it's so, but it's the way that these things are interpreted by the markets, right, and Wall Street. So Wall Street had already basically baked in that there was going to be a taper of some sort, and you know, we've had mortgage interest rates increase because of that.
Correct.
But not,
they
not
went to 3% from June to September on the threat of a taper, and now they're 3%. So it's the same thing.
Yeah, and you know, I think that, you know, obviously moving forward into 2014, I think that there will be a lot of people that feel like, you know, that this is their last to potentially buy a house because of where mortgage interest rates have moved to. I mean, I think that level of threshold, Lewis, when it starts to be like, I don't really know if it's sense for me to buy versus rent, when it starts getting into the 5 and 6% range. Now, granted, it's still very, you know, inexpensive, and I think that long term to lock yourself into a 30-year fixed rate and protect yourself from inflation is a smart move. And I think that, you know, sub 6% is that's fantastic, but there will be. But
it'll be unaffordable, Ryan. That's why they'll go to what you're talking about, the non-30-year mortgage. They'll start selling the other to make it more affordable, the ARMs and the adjustable rates and the ninja loans.
They already
and so
are,
on.
yes. Right. And you know what? They're really pushing the ARM products again, and there's a reason why they're pushing those products.
Yeah, of course. Get in now, you can get a lower rate, and if the prices go higher, well, you'll have price appreciation, or you can sell, or you can readjust then.
And we all know what happened the last time,
right?
When everything readjusted, and then the banks wouldn't work with anybody to refinance them into a fixed rate, right?
Right, which is why I don't think as many people will fall for it, or will go for it, or will qualify for it. So you're not going to have this big housing boomlet in terms of sales in the next couple of years, even if they do it. All they're going to be able to do is, again, protect the scarcity and try to raise the prices off of that scarcity by pumping up the demand just a little bit. But they're not going to be able to massively increase demand by offering these products.
Okay, so you're basically on board with prices. Home prices are going to go backwards next year, then?
No, I think what they'll try to offset, they'll try to increase demand through these products. It's basically, I wrote something on this, the catch-22, that as the prices rise, more inventory comes on the market. When more inventory comes on the market, then the prices go down again. So that you basically kind of get stuck. When you don't have, when you're looking at the housing market just in and of itself, and it's not based on an increase in the economy, then you don't have real money chasing houses. You have this artificial construct where you're just manipulating, or you're not manipulating, but the prices are going up a bit, so more inventory comes on the market. So when more inventory comes on the market, the price goes back down. You're kind of stuck at that level because there's nothing external in the economy to make housing prices go up other than manipulating interest rates, having prices go up, and then try to create demand by creating better or more attractive financing options. And because of that, it's not going to go. It can't really go much higher.
Right.
It'll probably stay where it is, but it could go much lower if the bottom falls out of the economy.
Right.
So I'm not predicting you're going to get 7, 8, 10, 12, or even 3 or 5% increase nationwide in home prices. You may get 10, 15% in Washington, San Francisco, and a few other areas if the stock market continues to go, and if the job market in Silicon Valley, and if the job market continues to be robust in the Washington, D.C. metro area. Right. And the rest of the country, they can't really rise much further. People don't have the incomes.
Absolutely. And I think nationally, I think that we'll probably see between a 2 and 4% increase nationally. That's what I'm predicting. But I've also
which statistically, Ryan, is nothing. I mean, it could just as easily be flat or down 2%.
Yeah, but I do feel like in the major metropolitan areas, the D.C. metro area and some surrounding areas, New York, New Jersey, and areas like that, I do think that they'll probably have a 5+% increase. But like I said, I think that we're in the middle of this shift, right, Lewis? So when we're going through the spring and into the summer, coming back out on the fall is where I think we'll really know where things are headed. We don't really have the data because the data is always it's always lagging. I mean, we just had, rising interest rates. They've been rising now month over month over month over month, but we're not going to really see how that plays out because not as many people are looking to buy through the fall and the winter as they are going to be in the spring. And they are
but on a seasonally adjusted basis, you can see pending home sales are down this year, this November versus last November. And you can kind of see that nationwide, the interest rates are now, year over year, are much higher than they were a year ago. And the general economy, forget what they're saying about the economy, isn't any better this year than it was last year. The employment situation certainly is no better than it was last year. Wages haven't increased over the past year. So you can have GDP growth or reduced jobless claims, whatever it is. In real terms, people are not doing better this year than they were last year. The only difference is now interest rates are higher, so it's harder to buy a home. And home prices are more expensive. So rising interest rates and higher home prices means it's harder to buy a home, so why would more people be looking to buy a home?
Yeah, I mean, it obviously, especially when people, it's not like they've got more money in savings accounts and anything else, you know what I mean? It's not like all of a sudden, which is why there will be more creative financing that has to appear because, like I said, there's really no other option, right?
I just thought of what's possible. Here's how you improve here's how through intervention they would improve the economy. I talk about money being in IRAs and 401k plans, right?
Yep.
And we've already talked about how they could, for patriotic reasons or for safety reasons, for our benefit, take some of that money and either put it towards a national debt or force you into US Treasuries. They might give you an option. They might say, okay, but if you buy a residence with it, then we're not going to take it. You can take it out and you won't lose your money. So in a way, that's one way of boosting housing. That's another way of either kill two birds with one stone. In their minds, they boost the economy. That money's just sitting in there in those 401k plans. Keynesians love to have money flowing around the economy, just being spent. Well, you can say to people, we're either going to put you in the US Treasury, which a lot of people will do. We're just going to convert that money, or we'll let you buy a house with it, and you won't suffer penalties.
Right.
And so that would drive the housing market.
It's
something like that. I'm not saying these things are going to happen, but there's something that's going to be much more involved with the average person having either a decision thrust upon them or force them to make a decision, or basically just telling them you're going to pay higher taxes, you're going to lose some money out of your bank account, you're going to lose some of your 401k or something, because that's where the money is. Right. That's the only last untapped pile of money other than printing more of it, which you've seen hasn't worked. Now, I'm not saying if they do any of this, it's going to work. It's going to be a disaster, but that's what they're thinking, I'm sure.
I would agree with you. I've kind of said a while back that, that the untapped retirement accounts and stuff like that's their next place to go. And
well, here's why, Ryan, because the baby boomers have just started to retire. They're going to take that money out anyway.
Yep.
What they don't want people to do is take it out and shelter it so that the kids get it. They want them to spend it.
Yep.
So they'll either take it from them and have it go to the government bonds, or they'll say you have to buy a house with it, or not have to buy a house. If you buy a house with it, you won't have these penalties.
Yeah. Anything.
But the stock market will go down anyway as they sell the shares.
Right. But anybody, that can continue to do stuff to continue to prop up the real estate market, they're willing to go to any lengths to do that,
Right.
So, there definitely probably will be some creative things that they come up with over the next year or so. So if we have an average 30-year fixed rate of about, 4.56% as of today, where would you say this time next year in 2014 that the range of interest rates will be? Do you think they'll be somewhere around where they're at now, slightly higher?
They'll be higher, but as I mentioned, they realize that where their bread is buttered, that they cannot have interest rates go much higher. So they will do whatever they can to keep those rates low. Remember, if they do get out of control, then we do have at least a short-term economic disaster.
Yep.
In other words, if the Fed somehow, either through QE or whatever else they do, cannot keep interest rates, the 10-year under 4% during 2014, you'll have an economic collapse. So they will do whatever they can to keep them the 10-year around 3 or slightly higher. They cannot afford to allow it to go much higher.
Yeah, I agree with you. I think that interest rates...
they should go much higher. They would go much higher if they did nothing.
Well, yeah, I mean, obviously, if we had any sort of normal market right now, they'd be probably 7 or 8%.
Correct.
But
just based on historics, not because you can predict it. It's just the cost of money generally costs a little more than nothing.
Absolutely. And so knowing that, I would say that, interest rates will still remain between 4.5% and 5% probably.
You're talking about the 30-year.
Yeah, the 30-year. I think the 30-year will probably stay somewhere between that 4.5% and 5% range. And I can see, the adjustable rate mortgages becoming, the spreads between those and the 30-year fixed will probably become a little bit greater, where they try to push more people into those products.
Right.
Which gives people a sense that things are a little bit more affordable, even though they're in the short term they are, right?
Well, because their monthly payments won't be that high.
Absolutely.
They'll be the same as if they'd taken out a 30-year mortgage a year or two ago.
Yeah, and ironic enough, people, I'm not going to say all people, but new buyers, right? Buyers that didn't have to go through the pain of maybe having their house foreclosed on or short sale because their adjustable rate mortgage went up and they couldn't afford it. People that are new to the market that do have jobs and this is their first time buying a house, they haven't gone through an experience like that, Louis, so they might be more apt to take some of that risk. Right?
Correct. The problem is, are there enough of those people, given the job prospects of the latest upcoming, the millennials as the next home buying generation, and given that not only do they not have jobs, they have crushing student loan debt burdens. So, they may not, the ones that are able may not blink at it, but are there enough of them to sustain the housing market?
Yeah, and that's what we'll be finding out, I think, in the next year or two. And I feel like ultimately, I feel like that, things aren't going to completely crash while Obama's in office. I feel like he's going to leave that for the next person. Can we give?
We didn't even mention Obamacare. I mean, that's going to have a big impact. People have less disposable income come January when they start paying their higher premiums.
Yeah, I mean, and I've talked to 2 or 3 other people that they've been given notice that their basically their insurance through their pension funds or whatever else are going to be cut off as of 2015. They've already been given notice, right? So, I mean, there's a lot of these long-term implications for people driving, more. People are going to have more monthly debt. They're going to be paying higher premiums. Wages are not going up, right?
Right.
We've got people getting, more people fired than hired. I mean, that's just the nature of the beast. We've got more people going on unemployment benefits. So I would assume that you're going to agree with me that they're probably going to obviously extend the unemployment benefits as well, right?
Well, they didn't. Didn't they allow, as part of the long-term unemployment benefit plan to expire last week or this week?
Yeah, and I think that just automatically kicked something in or something.
Yeah, I don't know, but I would think, unfortunately for the economy, the more you extend those benefits, the worse the economy gets. It may help the people short term, but the point is it's a sign that because you have to do it, the economy isn't getting better, and doing it in and of itself doesn't make the economy better.
Right. I mean, it just makes people more and more, or our economy as a whole, more and more unproductive. I mean, as if,
right.
Like you said, we already have a very unproductive economy. It's not. I mean, we have Facebook and Twitter, like you said, and look at their crazy valuations. How much real value are they actually putting out there to the economy?
Or right? Tesla. I mean,
yeah.
So what? They made a few thousand electric cars. That's not going to drive the economy.
No, and I mean, yeah, you do have, and see, in times like this, you would
Netflix.
think that,
people watching more movies. That's a sign of lack of production. Sitting around in front of your TV set collecting benefits and watching Netflix.
Well, and in the times like this, there are plenty of people that would maybe like to open businesses or do things like that, but they don't have any capital to start up with.
It's the all-time low, Ryan. The people working for themselves, I think, is 5 or 6%. It's the lowest it's ever been.
And that's
no one even thinks to do that because it's too much of a nuisance.
Sense, though. You know what I mean? That would make absolute sense as to why we're in such a mess right now. I mean, because instead of being innovative, instead of getting off your tail and going and figure out a way to do something, taking a business that's already there and finding a better way to do things, which is what people used to do, right?
Right.
But that doesn't
and you'd
happen.
Get rewarded for it. Look at the millennials. They're shut out because they were told, go to college, get a job. That didn't happen. So they don't know what to do with themselves. I mean, they've been shut out because the last 5 years has been spent propping up the existing structure that shut them out. What they should be doing is hoping for a collapse so they'll get an equal shot, or they should be shunning the traditional ways and going out and starting their own businesses.
Yeah, I agree.
But it's hard to do when you owe money. You have to find a job somewhere.
Well, I was about to say, it's hard to open a business when you owe money, right? And then you go to a bank and they look at you sideways because they won't give you any startup capital, right?
Right.
So where are you left to turn to? You're left to turn to your friends, family members, or, somebody else that could potentially sort of, angel investor or something like that.
And they haven't been taught any of this in school. So why would they even think to do that? They've been taught you go to school, you get decent grades, and then you go to college, and you come out and you get a job.
Yeah, and what's interesting is because there are those websites out there like for crowdsourcing, like Kickstarter.com and some things like that, where people have ideas and they post them on there and they try to get the general public to fund them. What's interesting about that, though, is, Lewis, is don't think for a second, though, that the government and whoever else is going to get involved with that at some point and say things that they can and can't do, right? And investing into these businesses, because you would think that that's a great way to get funded, is to have just people that want to give money to your company and start up that way versus having to go to a bank. And most of them, all they're doing is when you put so much money in there, they're going to give you access to get that product at a reduced rate, or they're giving you something for it. I mean, I love that innovative side of things there, but that's not the majority, right? That's still very up.
It's not in the mindset of an entire generation. It'll start to, and by definition, after 5 years, I think now the people that are in their 15, 16, 17-year-old age range, they're looking and saying, they're starting to reevaluate. Their parents are reevaluating, do I send my kid to college? What is the way that my child is going to get a better head start in the world? Is it going to be going to college and trying to get a job at a company that's been laying off people for the last 5 years?
Right.
I think that's where things are going to change. It's just that it's taken 5 years of this economy, which is basically, in a sense, shut out an entire generation who prepared for an economy that shut them out.
Right.
And maybe you'll have people, Bitcoin is a good example. I'm not in favor of how it works, or I don't think it's a valuable commodity or asset, but that was created by young people as an alternative. So it's those types of things that are good, that if they see that their place is not going to be by following the established order that shut them out, they're going to create something outside of the system. And, maybe there'll be enough people who made, tens of millions of dollars on Bitcoin that'll set up other types of companies and arrangements and provide opportunities for young people. Because the current system doesn't do it. The current system of QE has been designed to entrench the established players.
Yeah,
and there's no room for anyone else to come into that.
And the funny thing is the objectives of what the Federal Reserve and the reason for them doing QE and buying mortgage-backed securities was to help the economy. They've actually completely did the opposite, right?
No, they rewarded failure. They enshrined failure.
And they've created the same madness that we just came out of.
Correct.
Right? I mean,
and they're going to protect it again. They're not going to say, you know what, we'll let it collapse and give somebody else a chance, give somebody else who's a better steward of capital, someone else who can come up with better ideas. They've closed off capital. Capital's in 4 banks.
It is. I mean, it's absolutely.
And it goes towards trading. Think about it. It goes towards trading. London whale, all that nonsense. That's not productive to the economy. That doesn't create goods or services. That just gives bankers bigger bonuses.
Yeah, I was just looking at my computer just now, Lewis, and it looks like the pending home sales came in at 0.02 versus the estimated 1.1%. So another negative report for housing, but don't worry, there'll be another report later this week that will come back and will be some sort of positive news.
Well, I think you're right, but not about housing. I think they've given up. I think that housing is probably not the linchpin anymore of the economy. I think it's just continuing to boost the stock market.
No, I think that housing has become back page news now, right?
Right.
It's no longer at the forefront, even though that's what had been at the forefront for so long, because
right.
with low interest rates and rising prices, but now we have rising interest
right.
rates. We don't want to put that on the front page.
You know, I don't even cover it as much as I used to. All through the spring and summer, I was harping on the fact that there wasn't a real housing recovery, that this was going to end pretty quickly. And now that the signs are there that it basically has ended, I don't spend as much time on it because this was all very predictable. Of course there's not going to be more home sales. Of course prices aren't going to rise as much. Unless the economy gets healthy, that's not going to happen.
Yeah. So as far as employment for 2014, you see it saying the same or getting worse?
Worse. Unless they do some make-work program, because there's nothing on the horizon. And in fact, it'll get worse if you have a stock market crash, because all these companies on Silicon Valley, you know, they hire people that they don't even need. But as soon as the stock price takes a hit, they need to show, you know, that they're not, instead of losing, you know, $30 million a quarter, they'll start losing $50 million a quarter. They have to start cutting heads when that happens.
Yeah,
and
I agree.
If that happens, who's going to hire people that worked at Twitter or Facebook for a year or two? There are people lucky enough to get those jobs.
Yeah.
But
yeah,
then,
I mean, you know, and the sad part is, Lewis, is there's a lot of talent that's out there, right?
Tremendous.
But they don't know what to do with it. They're just confused because they've been told their whole lives that you just
Correct.
go to school, you get that degree, you come out, and when you come out, those jobs are just going to be waiting for you. And unfortunately, that's not what's going on. That's not the case. I mean,
and then they were told, go back to school. When it blows over, you'll be in a better position because you'll be even more educated.
Yeah, and the problem is that nobody's telling them that the Fed is in such control of our economy right now that nothing's going to change as long as they continue to implement these silly programs.
Look what you used to have, Ryan. People would come to the United States in the early 1900s. They would be street peddlers. You can't even just say to yourself, I'm going to be a street peddler. I'm going to get up at 5 in the morning. I'm going to go collect walnuts or whatever it is and peddle them on the street. You're not even allowed to do that.
Right.
But there were people who would, through the peddling, you know, Jewish immigrants did this. They became peddlers. They made some money, so they abandoned their cart. They rented a kiosk. And next thing you know, they had a department store. Not next thing you know. What I'm saying is there was an ease of entrance into making money by providing a good or service because there was no real barrier to entry other than your willingness to do it.
Yep.
You didn't even need a lot of capital
to
start. But now, because if you graduate college, you're not going to go be a peddler.
No, not at all.
I mean, you can't even afford to. It's beyond. It's also in the culture that, you know, I heard this 10, 15 years ago. They work, we think, meaning, you know, all the real productive capacity in factories is done by Asians.
Yep.
The Americans, they just come up with these grand ideas. There's not enough. There's 300 million people in the country to be sitting around thinking of ideas to be employed.
Ideas. Yeah, it's vision without execution is delusion. I use that quote all the time because most people have the idea that they want to do something but never actually do anything with it. It's sad and unfortunate. That's what's got to change. And I mean, that's what needs to be pushed out there to these kids as they're coming through school. We're running a little short on time here, Lewis, but what I want to do is I'm going to actually make this a two-part show, so I still want to get into some more predictions for 2014, so next week we'll dive into gold and silver prices and some of the other things that we like to talk about, and then we'll dive into a separate segment next week also as to what people can do to protect themselves from what's taking place now, and help them make more informed decisions, real estate decisions in general, economic decisions in 2014. I appreciate your time as always, Lewis.
Likewise, Ryan.
Thank you guys for tuning in. If you want to check out Lewis's blog, check it out at smaugled.com. It's SMAUGLD.com. And also check out our website at realestate360live.com. Until next week, we'll be back then.